and for markets, it's quite hard. It's always been hard to price geopolitical risk, and even if we see volatility spike in relation to that, it's often fleeting. In this instance, we haven't really seen much volatility, to be honest. Cross-asset volatility has remained low outside commodity markets in relation to this geopolitical event. Bond market volatility is at a 4-year low. That's helped US equities grind higher. FX volatility remains really subdued, but the complacency, I think, is what the real risk here is, because the quieter markets get, especially in the face of mounting flashpoints like we're seeing, the more violent an eventual breakout tends to be.
This is Converge, a podcast from Convera. Come with us as we shape the future of finance.
Welcome back to the Converge Market Update. It is almost mid of January. I have George Vessey with me again. George, good to see you. We're only days into 2026, and no surprise, I suppose, already the geopolitical landscape has shifted dramatically. Fed independence is once again back under scrutiny. And George, we'd love for you to break this down for us. We know you're our FX and macro strategist, so you have a lot to say here. To begin, let's unpack the biggest development of the week. What does the U.S., well, this was a couple weeks ago now, what does the U.S. move in Venezuela signal for the markets, and how consequential has this been over the last couple weeks since it transpired? And then we'll get into some of the more recent crazy stuff with the Fed.
Yeah, thanks, Alex. Happy New Year to you. It's good to be back at it.
Yeah.
But yeah, unfortunately, it wasn't the smoothest start to the year that we were hoping for. Like you said, the geopolitical landscape has shifted dramatically. Major military operation in Venezuela signals what looks like a new geopolitical regime, where we're seeing major powers more willing to act unilaterally, test the limits of those long-standing norms. This kind of shift raises the odds of one, miscalculation, two, any kind of retaliation, but also some unintended spillovers. And for markets, it's quite hard. It's always been hard to price geopolitical risk, and even if we see volatility spike in relation to that, it's often fleeting. In this instance, we haven't really seen much volatility, to be honest. Cross-asset volatility has remained low outside commodity markets in relation to this geopolitical event. Bond market volatility is at a 4-year low. That's helped US equities grind higher. FX volatility remains really subdued, but the complacency, I think, is what the real risk here is, because the quieter markets get, especially in the face of mounting flashpoints like we're seeing, the more violent an eventual breakout tends to be.
Yeah, we certainly know that. Markets may look calm, but the calm is exactly what makes that setup more dangerous. So what do you think? What about the notion that the U.S. move in Venezuela is all about oil? Is that really what's driving this, or is there something more strategic at play?
I mean, yes, it is about oil, but it's not in the most obvious sense, I suppose. Venezuela supplies barely 1% of global oil output. It produces heavy crude, which the market's already well stocked with. And, it also lacks the infrastructure or investment environment to really ramp up production in any meaningful time frame. So I think the real driver here is the regional power projection. This is about the US reasserting dominance in the Western Hemisphere. It's also about signaling to rivals like China and Russia, Iran, that the US is prepared to enforce red lines and enforce them inside its own neighborhood. And you can see that pattern already. Trump has verbally gone after Colombia, Cuba, Mexico as well over the last few weeks. And this is why people are now talking about this emerging Monroe Doctrine, which is essentially a modern twist on the old Monroe Doctrine, the idea that the US has a special right to act decisively across the Americas to try and shape outcomes in its favor.
Yeah, so less about barrels, more about power and signaling. So given that shift and the way that this Donnie Rowe doctrine has started to take shape, what would you say is the biggest risk that really comes out of all of this?
I think the biggest risk is that this type of action sets a dangerous precedent, because it changes the rules of behavior between the major powers. So other powers may feel more emboldened if you think about China in Taiwan, for example, or Russia in Eastern Europe. That's the core risk for me. These unintended spillovers that I mentioned earlier. Then, of course, you've got Trump saying that the US needs Greenland, framing that as vital to national security, raising tensions with NATO, of course. And then we've got the Iran story. US and Israel could use the current anti-government protest as a pretext for another intervention there. Now, ultimately, we're seeing this snowball effect. We're seeing that geopolitical shocks are becoming more frequent. And that's in an increasingly regionalized world. And that's actually something that we highlighted in our Are You Ready for 2026 report. It was a key theme. So, it's worth revisiting that given the latest developments. And, I guess a major question or an underlying risk related to all of this is just how long markets can stay calm, as you said, while this geopolitical stress keeps rising.
Yeah, we'll pop the link to the Are You Ready for 2026 report in the show notes today if you care to take a deeper look at what George is covering and the outlook for this year. But let's shift to the other major story, because that did shake markets quite a bit, didn't it? The Fed independence is under scrutiny once again. What exactly happened there, and what's the latest?
Yeah, you're right, Alex. And yeah, we did see that volatility pick up immediately at the start of this week after Trump once again upped the ante in that long-running feud with Fed Chair Powell. So basically, the story here is that the Federal Reserve received grand jury subpoenas from the Department of Justice, and that's related to his testimony about the renovation works at the Fed's headquarters. Supposedly, we all know this is more about the lack of rate cuts that the Fed have implemented, and Jerome Powell himself has described it as an attack, a direct attack on the Fed's independence. And, the market reaction was driven by the fear that political interference could spill into monetary policy. In terms of those market reactions, the downside risks for the US dollar are significant here, because if investors sense further pressure on the Fed, then again, this reinforces that kind of that play that we saw in the middle of last year in 2025 with the Fed independence risk, where that policy credibility and institutional risk really dragged the dollar down. But the bond market is the key barometer here as well. On the front end, markets could start pricing in more rate cuts. And on the long end, any signs of stress around the independence risk rising could trigger a sharp steepening of the yield curve, which would weigh heavily on the US dollar as well. But that said, the initial reaction was dollar negative, but we've already seen some of that position unwind. And that's because, we've seen several Republican lawmakers even pushing back against that DOJ probe. Senator Tom Tillis, for example, threatened to oppose the next Fed chair nominee until the issue is resolved here. And plus, globally, there's been a reaction. Global central bank chiefs have said they stand in full solidarity with Jay Powell. So the market reaction, it was volatile in the immediate aftermath of all of this coming through, but it's certainly cooled off over the last 24 hours or so. I want to see more or hear more reassurance, ideally from Trump or the Department of Justice. But if the investigation is ultimately dropped, Alex, I think the dollar could actually emerge stronger, because markets may interpret that outcome as power being further legitimized, giving him more room to adopt potentially a more hawkish stance in terms of rate expectations, and that could cap risk taking in wider markets as well.
Yeah, and what about that hawkish stance? Would it be warranted given the U.S. macro climate? I know the December CPI inflation came in at 2.7, in line with expectations. Core CPI inflation came in at 2.6, just below expectations of 2.7. What exactly are you thinking about how the Fed is going to be interpreting this data?
Yeah, I think right now, and a lot of analysts and markets are kind of split on the issue. One camp thinks we could see a full percentage point of cuts this year, 100 basis points. Well, there's another camp that argues even half that amount would be too dovish. And that really shows how uncertain the policy path of the Fed has become. But before I get onto the CPI talk, we did see some hawkish repricing last Friday after the jobs report was released. That was despite the non-farm payrolls missing forecast coming in at 50K. And that leaving 2025 as the weakest year for US job creation since 2020. So big story there. But we saw hawkish repricing in the Fed curve. And we think that's probably a result of the fall that we saw in the unemployment rate, but also the softening in wage growth. today's inflation numbers, as you said, push things the other way. The headline came in as expected, but that core reading, like you said, surprised to the downside of 2.6. And that really puts a March rate cut back on the table. I mean, there's some talk of a January cut, still a potential probability, but markets are pricing in barely less than 5% of that happening. If that was to happen, it would be a huge shock. And I don't think the Fed would take that risk. But it does put a March rate cut back on the table. So we'll see. But the truth is, though, with this inflation data, there isn't a huge amount to read into the details, to be honest, because that data collection was disrupted by the government shutdown last year. So the signal is a bit noisy, to be honest with you.
Yeah, it makes a lot of sense. All right, lastly, George, take into account everything we've discussed today. Where's the money flowing right now? Speak to the FX space, if you would.
Well, in FX, more recently, I guess the Swiss franc is the standout. It's behaving exactly as you expect it to when investors want a clean hedge against this Fed independence risk. But if you look back at how markets traded through similar episodes in 2025 with this Fed independence risk, the euro, the Swedish krona could also be meaningful beneficiaries if this story develops. More broadly, markets are very much in wait and see mode. Investors just want a bit more clarity on what these subpoenas actually mean for the Fed in practice before taking any bigger directional bets. But on the commodity side, I mean, the big story there, as we know, is gold and silver. They continue to climb fast, continuing their rallies from 2025 in that classic safe haven behavior when we see these ongoing geopolitical risks and policy uncertainty rising. And you'll see that spill over into crypto as well. Investors treating it as a high beta hedge against US institutional risk. So we've seen the crypto market make a bit of a rebound or attempted rebound today. We'll see how long that lasts. But again, that might be supported by the softer inflation figures that we've had out today too.
Yeah, keyword is attempted, right? Until proven otherwise. All right, George, thanks so much. That was great overview of where we're standing now. And we look forward to checking in with you in a couple of weeks again. Thanks for joining us today.
Thanks a lot, Alex.